different office, different people. That one wasn't an insolvency. These ones I've never used to buy that one, so I've never crossed over. But like I say, the only reason I use people like Tennants and Begbies is they do play a slightly straighter game, and the small ones that I've used have been completely unscrupulous. On one occasion it was to my benefit, but most of the time it's just too much aggro, and the possibility of it then unravelling in the future is just too big a risk to take. You know, you want to know that at least if you've done the deal, that you've done the deal, and that that their professional indemnity insurance is big enough to take it if they've done anything wrong. So work in progress.
So sorry, Jeremy. So what is the bottom line about the valuation normally that you pay?
The what, sorry?
How much is the bottom line that you pay for the valuation?
Well, yeah, I'm running through the sort of components of that now. So the first part of the valuation will be the chattels, which, like I say, they will take a view on, but that view will be a very small percentage of what the computers and everything else would have cost on day one. And typically 5 to 10% of what they cost day one, you should be able to get away with. The next part will be the work in progress, which is hard to value because if you're not there, the work doesn't get done, and therefore the value is not the value from it doesn't materialise. So I mean, say there's 100 grand's worth of contracts to be completed. They will argue as close to 100 grand as possible. You need to look at what type of business it is. If it's something where there's a high cost of delivery, like a training company where you've actually got to go and do the training, so you need the people to do it, then it might have a higher cost to deliver than something that's already there. You just need to send out or whatever, something you inherit with it. So the work in progress is something that you can normally value on a deferred basis, and it's up to you just to do the best deal you can with the liquidator. But a typical example will be, as we fulfil these contracts, we'll pay a percentage out to you as we complete. So I'm trying to think of a good example of one of those that I've done. Probably the telecoms one, actually, because we inherited a large number of contracts that were paying on direct debit, and so we agreed to make payments for them for the 8 months after we'd bought, in direct relation to retaining those customers. Next one is debtors. So say again, we'll use 100 grand's worth of debtors. So the debtors are what their customers owe the business. Again, the best bet is to try and take those debtors over, and for you to manage the debtors ledger and collect it, and give them a chunk of it back, but retain a percentage for the collection process. Now, I've typically got away with charging a 20% fee for the collection of those debtors, and you're the favoured collector because you're providing the service on an ongoing basis, and so they'd prefer that you were the one that then picked it up and ran with it. So out of that 100k, you would pay them 80, but again, you can defer that to quite a long distance in the future. So with the telecoms company, the way we did it is we said we would send them a quarterly summary of what we'd collected. We'd send them a quarterly summary of what we collected, and we would then pay them 30 days after that their 80%. So effectively you did get to sit on the cash for quite a long period of time sometimes before you actually handed it over. And then at the end of, I think we did that for 2 quarters, and at the end of that we would treat everything as bad debt. So there was a proportion, 20 grand out of the 100 that we treated as bad debt that you might actually then get a bit of later on. And
you offer to take care of you collecting the debt as a bargaining chip, I can imagine. Is that right?
Yeah, I mean,
or do you want to be in control of chasing money?
You want to be in control of chasing the money, because one of the key things is maintaining a seamless contact with those customers. If the liquidator goes after them, then the customers know it's gone into liquidation. Right, okay. Now, I'm not saying that you lie to them and say it hasn't gone into liquidation, but at least when you're dealing with them, you can say, yeah, they have had a few problems, but we're here now, it's all okay. We're supplying you the service on an ongoing basis, and we'd like you to, like you to pay for what you've had thus far. So it's as much about, one of the things that happens in that scenario is obviously you've got the creditors on this side and the debtors on this side, and for the debtors it's got to be seen as kind of business as usual, let's all carry on, and for the creditors it's definitely not business as usual, and it's whatever they're in for so far is finished. Having said that, on the creditors side, with quite a few businesses you'll find that creditors are key, because they're suppliers and things like that. Now, you're not allowed to prefer creditors. In other words, as part of the transaction, you can't pay their invoices, but sometimes you need to persuade them to carry on dealing with you. And again, I've successfully been able to do that in most of the businesses that I've got involved with, because actually they'd much prefer somebody just sit down and be completely straight with them. And when you sit them down and say, look, I'm sorry, this one's gone wrong, you're going to lose your money, but we want to work with you going forwards, and we still think there's a good business under here, and we're going to turn it around, it's all going to be better, and you'll have a great customer for a long period of time. It actually washes quite well. There was only one where I had to suggest that maybe we pay them a little bit more on their wholesale price going forwards to compensate for it over a period of time, and they actually kept a separate ledger for what we'd overpaid until we got to the point where we'd overpaid the amount that they'd lost on the first one, and then readjust the pricing, which is sort of a preferring creditors, but not quite. But you can sit down and have, the key thing I think is actually going and seeing these people and sitting across the table from them if they're key to the business, because they won't have had that before. They won't have had that from the previous people. In fact, the previous people probably wouldn't have returned their phone calls, answered the phone to them, let alone gone there and seen them. And I've walked into some situations where you think, God, this could actually be quite hostile, and it's not at all. It's they're actually quite relieved. Are you going to comment on that?
I was doing a deal with somebody, and because I offered to pay 80% of the debt, they let us off the last 20%. As long as I paid the 80%.
Yeah.
Yeah.
I think actually that's a really good point. People, I think businesses, you almost sort of prepare yourself to have to write off a bit every year, and it's the not knowing that's more frustrating. It's the why won't that bastard bring me back is more frustrating than, oh damn, I've lost it. Sometimes it's just nice to know, right, I've lost it, it's gone, wipe my mouth and move on, sort of thing. Let's look to the next one. Have you got any experiences in that space or?
Same time. I mean, you actually got to know when to get away, because if you stay in anything too long, that's what I was saying this morning. You say, okay, fine, and go. There's so many people who stick at anything past the point where you get any return. It's exactly the same with businesses. You've just got to say, I think that's good money after bad, gone. But that takes actually experience, because your first reaction is to stay in, keep going, keep negotiating, and it's actually wrong. But emotionally you'll want to be there. And that's the other thing, is never, ever, ever get emotionally attached to your business. Because it is a business. It's not your children, it's not your partner. But everybody does it.
And it costs them all that.
Absolutely. Absolutely. And because you're making the decision, as Jeremy said, there's a guy there who's got 60 people, he's paying them, he's got no money coming in, but he's paying these people because he feels, oh, it's mine, and he's attached. And in fact, the hardest thing, and I was saying to Richard today, that in terms of his business, these guys, they won't take photographs, they won't put reports in. Okay, the incentive is, here's the DB9 analogy, here's the keys to that car down there, do a good job. But the fear element is the bottom team every month, sorry guys, is going. And Richard said, but I don't want to do that, it's a family business. I said, yes, but you've got to do it, because especially now, going into recession, and we've all done that, Jeremy, I know that, going into recession, if you don't in actual fact cut hard, cut quickly, you can be out the game.
Has anyone here read Jack Welch, Winning?
Yeah, 10% yours.
Yeah. If you haven't read Jack Welch, Winning, he's done Straight from the Gut and Winning, and Straight for the Gut's more autobiographical, and Winning is more kind of instructional. Winning is by far and away the better book from my perspective, I think. I really like it, but yeah, that's exactly one of the things he talks about, which is, in fact, it's a really good book for anyone that manages people in general. It's just a whole.
Little one, 27 leadership secrets.
Right.
A small one, and if you just don't have much time to read the bigger one,
Yeah.
it's very good.
Is that a Jack Welch as well?
Jack
Is it?
Welch,
Yeah.
27 leadership secrets.
Yeah. No, he's an incredible leader and manager. I mean, he's like the super employee, isn't he? He's, behaves in such an entrepreneurial way. Yeah. You okay? How many was that? Once a wish, twice a kiss. You're going to the moon. 27 times you stop breathing, I think, isn't it?
Just have a question in relation to what Robert was saying this morning, which was exactly the opposite, and therefore is a contradiction. But I want to know where the line is between a business being your, choosing your business like your children,
yep,
and making it not so personal that it becomes your children.
Yeah, no, I think it's really important to be passionate about what you do, but you can be passionate about what you do at the same time as being detached from the commercial business nuts and bolts of it. Because the passion bit is the brand and the ethos and the way you present it to your customers and the way you you develop as a brand, but the business is the legal entity, the mechanics of what you do. And to summarise what Robert was saying, when the horse is dead, it's time to get off.
For example, like your property ladder. If you watch property ladder, that lady, I don't know her name. That lady, she would say, people would rearrange their houses to sell them, so that and they would all put colours, flowers, this and that. She said, no, do not do that.
White or
white,
cream.
Exactly.
Yeah.
There's no red walls. It's just beige.
Yeah.
Can you repeat again, please? When is the time to get off?
When the horse is dead. There's an old expression which is flogging a dead horse. So instead of saying flogging a dead horse, I say when the horse is dead, it's time to get off. So it's the same. It's the same analogy used in a more colourful way.
When when you see it's dying.
Yeah.
And it is going to die. So
Yeah.
Do you jump off or?
Well, that's different to the try and try again. Because the try and try again might be try another business. Don't give up on entrepreneurship. Make sure you keep trying. But also, in the back of your mind, when something's just fundamentally wrong. I mean, I've had people pitch business ideas to me, and they're pitching a business idea, and you find out they've been trying to do it for 5 years, and they haven't, they've spent a load of money, they haven't got anywhere, they haven't got it to do anything, and you've got to say, I don't know if any of you have heard me talk about my useful life thing, which is the first 20 years of your life you're useless fundamentally, because you're either pissed or too immature to get what it's all about. The last 20 years of your life, you spend... the last 20 years of your life, you're going to the toilet 3 times a night, so you're not much use then either. So you've fundamentally got this bit in the middle, which if you're really lucky is going to be about 20 years. So to do something constantly for 5 years and not... 40 years. What did I say?
20 years.
Oh, okay, 40 years, sorry.
I'm 42, I'm
Yeah. How many times did you go to the loo last night? Yeah. So yeah, you've got the 40 years bit in the middle. So if you do something for 10 years, for example, without getting anywhere, that's 25% of your useful life you've just burnt on not actually getting anywhere or not achieving what you want to achieve. And so, by definition, 5% of that, they're big chunks of your useful life. And I think when you start to think about it like that, it might make you think, right, if this doesn't work in 6 months, I'm going to do something that will work and I'll get traction quickly and I'll be successful at, because to keep pissing about, life's a wasting.
To that point, when I was saying this morning, you've got to keep constantly changing. What you do in that situation you described, it's slowing up, it hasn't quite died, but you're not going to make it to the oasis. So hop off and take the useful stuff. Now, the useful stuff could be some of the staff, could be some of the goods, whatever, and actually take that into a newer idea that you think's got more chance of surviving. Because there's no point in hanging around until it dies underneath you, because you might get crushed by it. And the other thing is to control, at all times, to control the process of something. If it's going to go down, don't bury your head in the sand. Get hold of an expert, get hold of an IP. And again, this morning when I said, whenever you are making your business work, you have a fund that you're saving into for the rainy day. That is actually where Jeremy was saying you can then get the good guys, the professionals, to help you out and say, okay, I see what you mean, we can shut that down, make them an offer of 10p in the pound, see that's going out, and then you can take your IP, which should be in a separate company, by the way, into the new vehicle.
Does everyone know what he means by saying the IP should be in a separate company? So if you have a brand or an idea or any registered trademarks or anything like that, the current school of thought is that you should stick those in a different vehicle. I'll give you a prime example. There was a sausage manufacturing business. Can't remember which one it was, but it was one of the quite well-known brands of sausages you could buy in the supermarkets. And they did an assessment on the valuation of the business. And they'd been making sausages since like 1842 or something like that, really, and quite a well-known brand. And they worked out the business was worth 150 million quid with the brand. But if you put the brand into a different company, the business was worth 150 million quid still, and the brand was worth another 50 million. So they actually increased the valuation of the business by 50 million by selling the two separately, because effectively this business would still make the sausages and still make the same profit, but pay a small license fee for the use of the brand, and then the brand business that's generating a license fee is then worth something to somebody that buys brands. And so there's, splitting it, it improves your value. Also, it's an insulation. If the business does go down, you've still got the brand, you've still got the intellectual property. So, yes, Caroline?
Yes, I just want to share a distinction that I got this last week with you all. If you're the shareholder in your business and the director and doing the work and everything else, then that is guaranteed almost business failure. Yeah. So what you could do is sack yourself as a director, yes, and then have the director accountable to you as a shareholder. That sounds easier said than done. But if you think about it, you're propping up your business from your own cash, and then you're invoicing your company to pay you, and there's no accountability. So if you manage somehow to split those roles or to get some sort of external view on your business, then I think you can see it far more rationally.
You should always behave like an owner, not a director.
Yeah.
There's an interesting spin as well. Depending on how long you've been a director, you can make yourself redundant and claim the redundancy payment without paying tax. There's no tax on redundancy payments. Up to 35 grand, I think.
About the people that you might inherit from a business, actually.
Well, actually, no, we covered a bit on 2P. Yeah. Interestingly, Caroline, for those that don't know her, is my lawyer. So she's the one that has to pick up the shit when I've when I've done one of these deals. Which did you get the last one? Okay, to fax over or no email over. I think we'll stop actually for a quick coffee, tea, toilet, sneezing, whatever anyone needs to do. Yeah, a cigarette for people like him. Yeah. So.
Next to do, so anything that you need doing that's not working, passwords, usernames, profiles. Anything.
It's a really good point actually on venue because we thought the boat was quite quirky and quite cool.
It's quirky.
But if the nauseous element outweighs the quirkiness, then perhaps we'll just find a boring hotel or something.
Anyone feel nauseous being on the boat?
So for the next one we do, which is January, for the January one, show of hands, dry land. Okay.
On that side.
Top side.
Actually, I mean, I think the whole boat is listed slightly, isn't it? Which might be a cause for concern.
Karen, can you find one of your houses that is just delivered and cleared out all the rubbish? Maybe we can help them all get in, carry a piece of furniture out into the master room for ourselves.
Before you get covered in paint. You can.
Okay, so that was the majority there, really.
I must talk to you about interior design. I'm moving house for the new year.
I think if you look at the downside for the people who like the boat going on dry land, it's less compared to the downside.
It's all right. So am I actually. So we'll talk in January.
There are challenges, but we've got an hour 15 minutes.
Okay, perfect. Let's plough on. So just what I'll do is I'll rattle through the valuation of a distressed business. So this is a business that's gone tits or about to go tits or is in trouble. I'll then talk about how you buy it, so the actual physical sort of payment structure. We'll then look at standard acquisition and how you can do that with no money and how you structure one of those. So, and in between, obviously, I'll rattle through this bit, then we'll have lots of open sort of questions and anything you want to ask that comes out of that. Then we'll do the normal acquisition and those questions that come out of that. So we've had the chattels, we've had the work in progress, we've had the debtors. Goodwill, like I say, you can in nearly all cases write down the goodwill. Goodwill might include something like intellectual property, and I have had a deal recently where they didn't put their intellectual property into another company, and unfortunately the person that was running the business had a very large personal guarantee, £250,000 personal guarantee on the business that was going bust. So if we went through a normal insolvency process, the bank would come after her and take her house away. And so as